cash flow. Everybody in real estate talks about it, but almost nobody explains what it should actually look like. If you're a beginner, you'll hear people throwing around numbers, $200 a month, $500 a door, or even if it's not 1% of the property's value, don't buy it. The problem is, those numbers don't mean much without context. The truth is, how much cash flow your rental property should make depends on way more than just a simple rule of thumb. It depends on the market you're in, the financing you use, the expenses you plan for or don't plan for, and the type of tenant you're renting to. This video is about breaking that down for you in plain English. I'm going to explain what real cash flow looks like. Not the fantasy numbers people post on social media, but the real, after expenses, after surprises, money in your pocket cash flow that matters. And by the end, you'll know exactly what's realistic for a first rental property and how to make sure you're not setting yourself up for disappointment. When people get into real estate, the first word they obsess over is cash flow. They'll ask, how much should I make per month from one property? As if there's a universal number carved in stone somewhere. And while it sounds simple, it's actually one of the most misunderstood parts of real estate investing. Some people will tell you that $100 per unit is fine. Others will say you shouldn't touch a property unless it makes $500 a month. And then there are those who throw around wild numbers to hype you into thinking rental income is a get-rich-quick plan. The truth lies in between all of that noise, and understanding it requires a little more nuance than just grabbing a number off YouTube or from a real estate guru. Cash flow is the money left in your pocket after every single expense tied to the property has been paid. That means not just your mortgage, but also property taxes, insurance, repairs, maintenance, management fees if you're not handling it yourself, vacancy periods when no rent is coming in, utilities if you're covering them, and even the small hidden costs people forget, like lawn care or HOA fees. If you don't factor in these details, the cash flow you think you're getting is just an illusion. A property that looks like it makes $400 a month on paper could easily shrink down to $100 or less once the real bills hit. That's why experienced investors always run their numbers conservatively, while beginners often set themselves up for disappointment by only looking at the mortgage versus the rent. Now let's talk about what's actually reasonable. A lot of old school investors used to follow something called the 1% rule, which meant that if the monthly rent was at least 1% of the purchase price, the property would probably cash flow. For example, buy a house at $200,000 and you'd want at least $2,000 in rent. That rule made sense decades ago when housing prices and interest rates were different. But in today's market, especially in hot areas, it doesn't hold up nearly as well. If you're in a high-growth market like Miami or Austin, you'll almost never hit that 1% rule, but that doesn't automatically mean it's a bad deal. On the flip side, in smaller Midwest towns, you might find properties that blow past the 1% rule, but come with slower appreciation or higher tenant risk. This is where context matters. Cash flow isn't just about the raw number, it's about the balance between income, expenses, and long-term potential. If you want a realistic range, many seasoned investors aim for somewhere between $200 to $400 per unit, per month, in true net cash flow after everything is paid. That might not sound like much at first, especially if you imagine becoming rich off your very first rental, but stack that over 10 properties, and suddenly you've built a steady extra income that covers all your bills. More importantly, it's sustainable. Chasing properties that promise huge cash flow but come with hidden risks, like rough neighborhoods with constant tenant turnover, can burn you out and cost more in headaches than they pay in rent. A smaller, steadier cash flow from a solid property in a stable neighborhood often wins in the long run. Another layer to this is financing. The same property can cash flow very differently depending on how you buy it. Put down 20% and get a traditional mortgage, and your monthly payment might be manageable enough to leave you a healthy cushion. Put down only 5% or use a high-interest loan, and suddenly what looked profitable is razor thin. That's why you can't just ask, how much should a rental property make? Without also asking, how am I financing it? Two investors could buy identical duplexes on the same street, but if one locked in a low interest rate and the other didn't, their cash flow could look like night and day. And then there's the tenant factor. Renting to college students in a university town might bring in higher rents, but you'll face faster wear and tear, more turnover, and possibly more unpaid rent. Renting to a long-term family tenant in a suburban area might give you lower rent compared to the student property, but you'll likely get stability, less turnover, and more consistent payments. Both properties could technically cash flow the same amount on paper, but the quality of that cash flow is drastically different. One might keep you up at night, while the other quietly pays you every month for years. The other mistake beginners make is forgetting about reserves. Even if your property cash flows $300 a month, what happens when the furnace breaks and you're hit with a $4,000 bill? If you've been pocketing that $300 without setting aside reserves, you're wiped out for over a year. Smart investors build in reserves as part of their system, so when the inevitable big repair comes, it doesn't destroy their cash flow or put them in debt. That's why some people say your first few years of cash flow aren't for you to spend. They're for you to protect the property and stabilize the investment. Once you've built that cushion, then the monthly income truly becomes passive and reliable. So how much should your rental property make? The real answer is, it should make enough to not only cover all your expenses, but also provide you with a buffer that makes the investment worthwhile. If you're making only $50 a month after everything, the property might technically cash flow. But one bad month can erase your profit. On the other hand, if you're bringing in $300 to $500 after all expenses and setting aside reserves, that's healthy, sustainable income. And as you scale, those numbers start to compound. What really separates successful investors from the rest is their understanding that cash flow isn't about chasing the biggest number. It's about consistency, sustainability, and peace of mind. You don't want a property that gives you wild swings of profit one month and losses the next. You want a property that quietly and predictably puts money in your pocket every single month while building equity in the background. Because remember, cash flow is only part of the wealth equation. Appreciation, loan paydown, and tax benefits all stack together with your monthly income to create long-term wealth. So the next time you run the numbers on a deal, don't just ask, how much does it cash flow? Ask yourself, is this number sustainable? Is it realistic? And does it give me breathing room? Because in rental real estate, a steady $300 a month you can count on is far more valuable than a flashy $800 that disappears the second something goes wrong. And that's the difference between being a beginner who chases hype and being an investor who builds a portfolio that lasts. Here's where most people miss the mark. They think cash flow is the only metric that matters. They'll reject deals that cash flow $150 a month because they think it's too small. Meanwhile, they're ignoring the fact that the property is sitting in a market that's appreciating 8% a year. Imagine turning down a deal that makes you $1,800 in net cash flow per year, but also adds $20,000 in equity annually because the neighborhood is booming. That's the difference between chasing short-term gratification and building long-term wealth. Cash flow keeps you in the game, but appreciation is what can make you rich. But let's zoom in on why cash flow still matters so much in the first place. It's your safety net. Think of cash flow as the oxygen tank that lets you stay underwater longer. Without it, even if you're sitting on a property that's gaining value, you could drown in negative numbers month after month. That's why smart investors don't look for the biggest cash flow. They look for the most reliable cash flow. Now, reliability isn't just about picking a good property. It's about running it like a business. Take maintenance, for example. If you ignore it, small problems snowball. A $200 leaky pipe can turn into a $5,000 water damage nightmare. That kind of hit destroys cash flow for months. On the other hand, if you budget for maintenance properly, set aside 5 to 10% of your rent every month, and actually schedule preventative upkeep, your cash flow stays smooth. That's the kind of behind-the-scenes discipline that separates someone bragging online about their rental income from someone who actually keeps it in real life. Let's also talk about location, not in the vague, location, location, location way you hear all the time, but in a cash flow context. A property in a trendy downtown area might appreciate faster, but the rent-to-price ratio could be terrible. You're paying $400,000 for a condo that only rents for $2,000 a month, which after expenses might leave you with barely anything in cash flow. Meanwhile, a $150,000 duplex in a working-class neighborhood might rent for $1,500 aside, giving you stronger monthly returns. But here's the catch. You need to weigh that higher cash flow against the stability of the tenant base, the risk of vacancies, and how the neighborhood will look in 10 years. That's why there's no single number that applies to everyone. It depends on what you value more. Consistent monthly income now, or long-term appreciation later. And financing, let's dig even deeper there, because this is where the majority of beginners completely misunderstand cash flow. If you buy a rental property with a 30-year mortgage at a good rate, your payment is predictable and relatively low. That leaves more room for cash flow. But if you get creative financing, say a hard money loan or adjustable rate mortgage, your payment might balloon after a few years, eating into your profit. The property didn't suddenly get worse. Your financing strategy made it worse. That's why the same rental can cash flow wildly differently depending on the investor's plan. Cash flow isn't a fixed number attached to the property. It's a moving target that shifts with your financing, expenses, and management. And here's a secret most first-time landlords never think about. The way you manage your tenants directly affects your cash flow. Late payments, evictions, constant turnover, they all chew through your profit. Even one vacant month can wipe out 6 months of cash flow. That's why screening tenants is not just some boring administrative task. It's the difference between being profitable and being stuck. A tenant who pays on time for 5 straight years is worth more to your bottom line than squeezing out an extra $100 in rent from someone who moves out after 6 months. Stability beats flash every time. Something else you'll rarely hear: taxes. Depending on your local laws, property taxes can climb year after year. And if you didn't build that into your projections, you'll watch your cash flow shrink right in front of you. And it's not just property tax. It's also how you handle the tax benefits. Depreciation, write-offs, mortgage interest deductions, all of these are tools that can increase your effective cash flow by reducing your taxable income. A beginner who ignores tax planning might think they're only making $200 a month, while a savvy investor who uses depreciation and deductions correctly could be effectively pulling $400 or more. Same property, same rent, totally different cash flow picture. So when you ask how much cash flow a rental property should make, the honest answer is that it's not just about the raw dollar amount. It's about whether that amount is sustainable, resilient, and worth your time as an investor. A safe, boring $250 a month that shows up like clockwork, year after year, might not sound exciting, but it's far more powerful than a flashy $700 that disappears the first time the air conditioning breaks. The real goal isn't to win the lottery with one property. It's to build a machine that prints money slowly, steadily, and predictably, while also gaining value over time. So here's the bottom line. Cash flow isn't about chasing some magic number. It's about making sure your property pays you consistently, protects you when surprises hit, and gives you the breathing room to keep growing. If you're walking away from a deal with $200, $300, or $400 in real after-expenses profit each month, you're already ahead of most first-time investors who jumped in without running the numbers right. And once you start stacking those properties, that steady, predictable cash flow becomes the foundation of financial freedom. Don't get distracted by the hype. Don't compare your numbers to someone flashing screenshots on social media. Focus on sustainability, focus on reserves, and focus on properties that give you long-term security instead of short-term thrills. Because the investors who win aren't the ones chasing the biggest single paycheck. They're the ones who quietly build reliable income streams, one property at a time. My name is Real Estate with Pingo, and I break down real estate in a way that's simple, clear, and real. If this gave you value, hit that like button, subscribe, and share it with someone who's thinking about buying their first rental. Trust me, they need to hear this before they jump in. Because in real estate, the question isn't just how much cash flow should you make? The real question is, are you building something that lasts? And if you are, then you're on the right path.